Welcome back, everybody. Robinhood made a big splash last week with the news of their 3% cashback credit card, which of course found itself into videos all over YouTube. But the main question everybody wants to know is, with Robinhood being a company that has yet to hit consistent profitability, how can they afford to give you 3% cash back, and will that 3% benefit actually last? And believe it or not, the answer to that question is right there in Robinhood's financial statements, which we're going to dig into. So in this video, we're going to go over what Robinhood's new credit card's all about, break down how they can actually afford to give you 3% back, and talk through who the card is good for and who it's probably not good for. Let's go ahead and get started. So what is Robinhood's credit card all about? Now let's just take a look at the basic stats. The main selling point is that you get 3% cash back on all categories with no limit. Now, it's a heavy metal card, stainless steel unless you get the special gold version, and a Visa signature card, which is why a lot of the perks match up with other Visa signature cards, like trip protection, concierge service, extended warranty, and all that type of stuff. And those are all common things on other Visa signature cards and many other cards. You also get things like 5% back on travel booked through their portal, which is again pretty common with other carriers. Now, the card does say it's a no annual fee card, which I guess is technically true, but you have to have a Robinhood Gold subscription in order to apply and manage the card, which at its cheapest is $50 a year if you pay annually. So I would consider that like the annual fee for the card, but you do get other perks as a Robinhood Gold member with things like 5% on uninvested cash in brokerage accounts, higher instant deposit limits, as well as a 3% match on IRA contributions, assuming that you meet the minimum time requirements, plus unlimited 1% deposit boost, which is coming soon. But in general, it's a 3% cashback card that's trying to be more attractive than any other cashback card. And Vlad Tenev, the CEO of Robinhood, was just on CNBC talking about it as well. So let's listen to what he had to say.
What we'd like to do is build a world where for our customers, all of their assets are custodied at Robinhood, and every financial transaction goes through Robinhood. Typical cashback cards, we've surveyed the entire landscape. The highest that's sort of like commonly available with no limits is around 2%. And a lot of cashback cards are even lower than that, 1.5. So 3% is beyond what anyone else offers with no limit, no minimum balance, no net worth requirement to be part of the program.
How do you make money on that? Like that sounds like it's a little risky of a strategy, because the reason others are out there, I mean, unless you think everybody's not offering more just because they don't have to and they're all in collusion on doing that.
I think, credit cards are one of the most profitable segments in financial services, possibly the most profitable.
Yeah, because they don't give away that much cash. They have limits on what they set on it. They have real hefty checks that they put on people. How do you make money? Like, how does that come back?
There's two ways. So one way is because we sort of have a vertically integrated system, we not only earn the interchange revenue, but a credit card's also a lending product. So there's revenue on balances that customers hold.
Now, I just want to stop this right here, because when he says, quote, revenue on balances customers hold, in this context, it means that people who don't pay off their credit card balances each month, they obviously get charged fees. Now, because that's one of the three ways that credit cards actually make money. One, there's interchange, which is the per transaction revenue that they get with each swipe. Two, there's revolving balances, so that's people not paying off their balances in full each month and paying high interest rates on their card balance. And then there's the fact that cards can attract people to use other services that the card issuer provides that are also profitable and increases their overall customer revenue. And Vlad talks about that for Robinhood next.
There's generally two types of customers that use credit cards. There's folks that pay off their balance in full every month, and those are called more transactors. This is obviously a great card for transactors because of the rewards, but it's also an amazing card for people that are building credit. This might be, in my opinion, one of the best credit building cards out there as well. And for customers that are using it to build their credit, we do earn the economics on those balances.
Now, I'm a little curious about this because Vlad says that it's great for people who are building their credit, but why exactly? Because for people building credit, there's really three major things that are important in a credit card. One, can they be approved to get one in the first place? Because a lot of times they either have no credit or less than stellar credit. And then number 2, what fees are involved. And then 3, what's the interest rate they'll have to pay if they have a revolving balance, which is what he implies that they'll likely have in that clip. So in terms of the first point, approvals, it's not clear yet what type of credit score is going to be needed, but some reviews of the Robinhood card expect it to be good to excellent. Now, other articles say that he's trying to approve as many as he can, so I'm not really sure on that one. But then for the second point, which is fees, everywhere it says that it's a no annual fee card, but as we know, that's a little bit misleading since you have to be a Robinhood Gold member in order to get one. Now, in terms of other fees, it's mostly things you see on other cards. There are no transaction fees and there's no balance transfer fees, which is pretty good. But then the card replacement fee of $40 seems a little bit excessive. But for the most part, the fees are relatively normal. Now, for the third point, interest rate, it's between 20.24% and 29.99%, which is towards the high end of what you can expect. Now, of course, a lot of cards are like this, and it's not specific to Robinhood, but you can easily do a search and find cards that advertise a slightly lower range, like the Double Cash card from Citi, that also has no annual fee and actually incentivizes you to pay your bills. And according to reports, you can get approved on that card with just a fair credit score. So I question the comment by Vlad here that it's, quote, one of the best credit building cards out there, because I don't see anything that would actually back that up. Now, I understand he's a CEO of a company, he's talking up his new product, and he's trying to get as many customers as he can. I just, don't really like the idea of being misleading or saying things that are just inaccurate for the sake of getting a new customer, but that's just me. But for the customers who are going to use all the products and services that Robinhood offers, in addition to the card, it actually makes a lot of sense. That's a scenario where it's good for the customer and good for Robinhood. And Vlad talks about that a little bit here.
And for customers that are transacting, it's all about the ecosystem benefit. And we've actually seen data on this from Robinhood Gold customers. Robinhood Gold customers are much more likely to adopt all of our other products. Their balances with us are higher. Mm-hmm. Their average revenue per user is multiples of a non-Gold customer. So once someone joins Gold, they tend to increase the amount of money they put in Robinhood. They do more with us. They're a more profitable customer. They get more value. So the idea is to just add more things to Robinhood Gold and for it to be a no-brainer value proposition. The whole idea behind Robinhood Gold is if you're a high net worth individual and you're accustomed to getting a level of service from your bank or other financial institution, we want to open up that sort of private client, high net worth experience for just $5 a month to the mass market. And that's where the retirement offer comes in, the high yield on cash, the premium credit card. All of these are products that you'd have to have a lot of money to be able to qualify for. And we're just trying to open them up to as many people as possible.
Now, this gets to the guts of what the 3% card is all about, because it's not really about the card itself. It's about a bigger vision that'll help Robinhood, the company, get to consistent profitability and future growth. So then how can Robinhood afford to give you 3% cash back? And now the short answer is they can't. Because if we simply look at the interchange rate for Visa signature cards, we can see that depending on the merchant type, they're getting at best 2.2% back in interchange or at worst 1.43%, which means that each transaction from an interchange to cashback perspective is running a deficit of between 0.8 to 1.57%. So on the surface, that doesn't sound great, but remember, one of the other ways that card issuers make money is for customers who don't pay their balance off in full each month. So if Robinhood has a lot of credit card users who don't pay off their full balance, then they'll charge them the 20 to 29% annual rate on their balances, and that will definitely improve their overall bottom line. Now, is that a good thing? It depends. It does help their financials, but Robinhood's supposed to be about taking from the rich and giving to the poor, and this is more like taking from the poor and giving it to the young company trying to get to profitability. It doesn't quite have the same ring to it. And look, I'm not saying that it's bad. I hold credit card issuers in my own portfolio, and this is just part of the business. I just think we should be super transparent about these things and not be misleading. I'm just not a fan of that. And the other risk for Robinhood is that if you have a lot of customers who can't pay their bills off in full, there's a risk that they won't pay them back at all. So it's a question of underwriting skill for Robinhood to get the right mix of customer. And if they can do that, then the credit card can be profitable on its own. but it likely means they'll have a larger group of customers with riskier financial behaviors, which can present its own challenges. So at this point, you might be thinking, this doesn't sound great at all, so why is Robinhood even doing this? And this is another place where researching stocks and understanding financial statements can be very helpful because we can get an idea of how a business is doing and what they're trying to accomplish. And if we look at Robinhood's statement of operations in their most recent 10K, there's something obvious that you can see. Now, first off, they've run at an operating loss for the last 3 years, but it's been slowly growing to profitability. And they've even reached profitability in their most recent quarter. But the challenge is, how can you stay at profitability when you just announced a 3% cashback card that you're probably taking a loss on? And if we take a look at Robinhood's revenues, it tells us more. Robinhood's 2023 revenues came back to surpass their 2021 revenues after a down year in 2022. But if you look at the trends in the different revenue types, it tells a story. Because transaction-based revenues are continuing to trend down, net interest revenues are trending up, and other revenues are basically flat. But what do any of those types actually mean? Well, transaction-based revenues are related to routing orders for trades, whether that's stocks, options, or crypto. And the payment for order flow stuff that was controversial during the whole Robinhood and GameStop thing. Now, net interest revenue is interest they earn minus any interest-related expenses, which includes cash that the company holds, as well as user deposits, margin loans to users, and revolving customer credit card balances. Okay, now we're getting somewhere. And then lastly, other revenues is basically Robinhood Gold subscription fees. So it makes sense that it would be a smaller piece of the pie, but probably something they expect some steady growth with. Now that we know what the segments mean, the trends make a little more sense to us. Trading-based revenues are trending down, net interest revenues related to user deposits is going up, and subscription fees are staying relatively the same. Now, the reason those are important is if we look at the cost breakdown, we can see that when Robinhood had more actual trading volume and transaction-based revenues, their costs were also higher. While they were able to double their net interest revenue from 2022 to 2023, with costs staying about the same. So what that tells me is that interest revenue is not only more profitable for Robinhood, but it's also more predictable. Because transaction revenue is dependent on market sentiment and retail investors and traders wanting to buy stocks, options, or crypto, or at least speculate on the market a little bit. It's also the highest risk revenue because there's always a chance that their payment to order flow process will face regulatory challenges as well. While interest revenue is mostly about people bringing their assets into Robinhood and holding them there. So clearly what Robinhood wants to do is bring more users and their assets over to their platform, which is why all the perks for their Robinhood Gold subscription are meant to do that. Because again, it's the 5% on uninvested cash and brokerage accounts, higher instant deposit limits, as well as that 3% match on IRA contributions, assuming that you meet the minimum time requirements. And of course, unlimited 1% deposit boost, which isn't there yet, but is coming soon. Everything they're doing is meant to incentivize you to hold more money and do more transactions at Robinhood. And Vlad even said it in the very first clip.
What we'd like to do is build a world where for our customers, all of their assets are custodied at Robinhood and every financial transaction goes through Robinhood.
See, the main idea with Robinhood Gold and the new credit card is to keep increasing this line item right here, net interest revenues. Not only with revolving credit card balances that they earn interest on, because that's going to be a new addition to that revenue line, but also on new brokerage deposits, IRA accounts, and margin loans from customers that want to move more of their financial assets to Robinhood. Especially now that they have a 3% cashback card that they hope is your primary card. And ultimately, if Robinhood succeeds at bringing over a bunch of people who bring their assets and are able to get that net interest revenue up, then they'll probably be able to provide that 3% cashback benefit as long as they can stay profitable. But then the other possibility is that if those things don't work, then they may have to revisit the terms and reduce the cashback number at some point. But at the end of the day, the question of whether or not Robinhood can afford to give you 3% cash back or not is a relatively simple one. They can't afford it. They're operating at a loss right now with the hopes of getting enough new users and new deposits in so that they can operate at a profit with higher margin revenue. And the cool part is that it's all right there in their financial statements. Now, does any of this mean that you shouldn't get the new Robinhood card? No, that's not what any of this means. I mean, just because they're still searching to be consistently profitable doesn't mean that this card isn't a good fit for a certain type of person. And let's talk about that. So who is this card actually good for? An obvious answer is people who are already subscribed to Robinhood Gold and using Robinhood accounts and services. Because at that point, any risk of Robinhood's actual platform is something that you're already comfortable with and you're already paying for gold. So in that case, the card is technically free for you. And for folks in that situation, it makes total sense to see how long the 3% cashback lasts and continue getting the added benefits of being a gold subscriber. Another group will be people interested in moving their primary investment accounts over to Robinhood already. If you like their platform but just hadn't made the move yet, the 3% card is an added perk that you'd be combining with the gold subscription perks of that 5% on uninvested cash, the higher instant deposit limits, the 3% IRA match, and the unlimited 1% deposit boost. So if you were already interested in those perks, also having access to a 3% cashback credit card is a nice addition. And then lastly, folks who simply want to maximize their cash back will pay their bill in full each month and are willing to spend more than $5,000 on the card. It probably makes sense for them as well. Because if you're in the group where you just want to have the best possible cashback opportunities, paying the $50 annual fee isn't a big deal as long as you're spending more than $5,000 on the card each year. And the reason for that number is you can get a 2% cashback card with no annual fee. So to make up for the extra $50 fee, you have to spend $5,000 to make up for it in the extra percentage you get back. And after that point, you'll be making an extra 1% for however much more that you spend. Now, is all that worth it to get a new subscription and get a new card and do all that? Only you can decide. But now, in terms of who the card is probably not good for, one, anybody just building their credit and not likely to pay it off in full each month. In spite of what Vlad says, I disagree that it's a good card for those building their credit. The APR is high, and having to pay for Robinhood Gold is not ideal. And it's not clear that you can even get approved with less than good credit. So for folks in that situation, I think there are better cards. And then anybody who's not going to take advantage of the other perks of Robinhood Gold. I think it's still up in the air on how long the 3% cash back is going to be a thing. So anyone who's also getting a lot of value out of Robinhood Gold already, the card is really just a bonus. So even if that cash back goes down, it would still make sense to use. But anyone who's just doing it for the card, I would just think about what you do if the terms change within the first 2 years and if that matters to you or not. Now, for me personally, if you wonder if I'm going to be getting the card myself, the answer is no, probably not. I use Schwab for my portfolio because I have some additional account types like HSA and a small business 401k, and I wouldn't be able to move those. And I like having everything in one place, and in general, I like Schwab. And in terms of cards that I actually use, I use a Schwab Amex Platinum that allows me to transfer my membership reward points as cash into my brokerage, and then some pretty normal Chase cards like the Amazon Prime card. So I'm not likely to change any of that anytime soon. But what do you guys think about the 3% cashback card from Robinhood? Is it something you're planning to get? Let me know down in the comments below. Now, if you want to see my stock portfolio and the tools that I use to manage it at Schwab, you can watch my most recent monthly portfolio update by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.